David, I want to get your take on the action, the quote-unquote orderly action we're seeing here today, and just the role that central bankers, both here in the U.S. and the world over, given what we've seen this week, are playing in it.
I mean, it's a central bank-driven market. I mean, every client that I speak to is unfortunately focusing in on macro, and they really don't want to focus in on macro. But it makes for good living for me, I guess. But it's not so fun for them, especially the more bottoms-up folks or the guys that are the guys that are on the investment banking side. So it is going to remain with us. I think you guys were 100% right in your earlier conversation. The Fed is stalwart. It's pushing. It wants to fight this inflation. It's going Volcker-esque, even though many people thought they wouldn't. And in many ways, that's the long-run game. That's what we should look to as the goal in the end, the positive, the anchoring of long-run inflation expectations and what that means for positive, maximum, sustainable growth that we can get down the road. We don't want to lose that anchor. That would be a return to the 70s and a lot of repair work. But there's a lot of pain that gets us across that Rubicon, and that's what we're taking right now. And we're just going to have to take that short-term pain to get to the long-run game.
How short-term do you think the pain is, and how deep do you think the selling could still go from here?
So I think, one thing I've been arguing for with our clients, and why I'm not in that 3,000 camp, and I haven't been, although I've been pretty negative for the bulk of this year, and I really think these are the levels that it gets very interesting to own, is that when you have a lot of nominal GDP, a lot of nominal income growth, not real growth, we're in negative real growth. We got a confirmation of that today. But we have 8% nominal growth. That's nominal income that's in the economy. Last year, nominal income grew at 12%. We're at 20% over 2 years in nominal income. It's very hard for assets like equity assets, commodities, real estate assets to go down and really stay down when you have a lot of nominal growth. And I think that nominal cushion is something we need to think about, especially if inflation sticks around a little longer. It's a negative. The Fed's going to have to go a little further, and you're going to go, oh, that hurts. Real rate's a little higher, the dollar higher, multiples a little lower. But we also have this nominal cushion that sort of helps with valuation and thinking about where the ultimate endpoint is for the S&P on a bottom. And Warren Buffett always told us to look at valuation pretty simply in the equity market by taking the total market cap and dividing it by nominal GDP. As I said, nominal GDP is ripping at levels we haven't seen in 30, 40 years, largely because of inflation. And if inflation stays persistent, it's going to stay high. And that should be a cushion to the downside. That's how I see the cushion to the downside. And that's why I can't get into that 3,000 or below 3,000 camp. I haven't been there all year, even though we've been quite negative and positioned quite negative. I think these are the levels where it actually gets far more interesting.
Yeah.
Just like it did
right here. These are the levels where. What does that mean, David? Far more interesting at these levels. Explain what you mean.
What I mean is I think that, David, that cushioning of nominal income growth starts to really kick in down here. And we're going to get a period at some point, nobody knows when the Fed actually says, okay, enough's in the system. We're going to watch it for a little while. We're going to get to 4. We're going to get to 4.5. We need to watch it. We've slowed things down. We're going to start to see it in the employment data. We're going to start to see it in the inflation data. We've already seen a lot of forward indicators of inflation come down. And as soon as the Fed kind of give you that, hey, we're going to watch for a little while, you're going to get a 5 to 7% pop in the S&P before you can blink. And maybe you don't want to be there for that because you have to go down a little too much to get there. But we're closer to that end game than people think. I don't know if it comes before the end of the year. It comes in Q1, but I think it comes in one of the two. And I'm very confident that if inflation stays sticky, David, that my nominal cushioning is going to buffer me on the way down, and I don't have nearly as much downside. We've gone 22, 23% down in the year. It's a lot. We've chopped a lot of wood. We've taken a lot of valuation out of this thing, rightfully so. Real rates are higher, dollar's stronger, multiples are lower, all the things we needed to do to fight this inflation. It's just not that exciting for me to play for another 10 to 20% down. I don't see the trade.
Shepard Smith here. Thanks for watching CNBC on YouTube.